Good morning and welcome to BloombergQuint, India's first digital live streaming business news service. I'm Nischal and you're watching IndianOpen. Let's go straight to the headlines at this hour. RBI's latest consumer survey shows optimism amongst consumers in the January to March period, contrary to most macro indicators. Titan says it's going to post strong revenue growth for the fiscal year gone by, making it the third straight financial year of healthy top-line growth for the company. Cites good growth prospects in FY20 as well. Jet Airways lenders will invite bids for stake sale in the airline on April 6th. And India's largest manufacturer of electric wires and cables, Polycab, is looking to raise 1350 crore rupees through its IPO, which opens for subscription today. Well, it's raining IPOs for sure, and most of them are turning out to be successful as well. As if Embassy REITs is any indication, if anchor investors for Polycab are any indication. We'll get to that in a bit. First, let's take a look at the trade setup for the day. The world is not looking a sad place. That's one thing that you got to keep in mind. Now, the big news, and it's probably not as big as one would want it to be, but the big news is updates on the trade tensions or the trade war between US and China. Now, the Chinese vice premier has said that US and China are one step closer to a negotiation. There's a new, according to state-run news agency, there is a new consensus that has been reached between the US and China on the text of the trade agreement. Now, Donald Trump did mention that when he spoke to reporters that we're still a few weeks away from an agreement being reached, but there is optimism on both sides, and this was the first remarkable statement made by officials on either of the two sides in the last few days. New consensus on the text of the trade agreement. China is certainly showing optimism on how this trade negotiations will move forward. So that is good news. Before that came in though, I think there was some optimism in the US markets any which ways, because the S&P 500 had the first 6-day winning streak in over a year, marginally higher for the S&P 500, Dow and Nasdaq. And Nasdaq has actually been doing rather well the last few days, and therefore it took a bit of a tempered move yesterday, but the Dow to about 36 odd points, so not bad. And this is pretty much what the Dow futures were indicating when we shut shop yesterday. In the Asian markets, the only one that is open today is Nikkei, which is up about 0.25%. The SGX Nifty indicates a start which is marginally in the green as well. Remember, it's not been very good the last few days. It was the second straight day of declines for our markets in trade yesterday. All the key indices came off. Nifty IT led the charge as far as the decliners go, so 1.37% lower, and that was the principal culprit in trade yesterday. The mid-cap index fell about nearly 100 points or thereabouts from the day's highs in trade yesterday too. So the market breadth was adverse, almost 2:3 in favor of the declines. And to add to all of that, while it may be showing a tempered mood right now, in yesterday's session, Brent crude topped the $70 per barrel mark for the first time since November. Currently at about 68.39 or 69 or thereabouts, but it's now nudging that 70 mark and staying steady because of supply side constraints. And as almost every expert will tell you, you can argue that demand may go up and down, and therefore crude prices will be volatile according to that. When it's because of supply side issues, it tends to be very sticky unless something materially changes on the supply side. And for now, if you look at the OPEC arguments, it doesn't seem that something will change materially in the near term at least. Never mind what Donald Trump would tweet out on an odd day. All of this had an impact on the currency as well. It snapped the 3-day winning streak. The currency ended sharply lower yesterday, 69.16 for the rupee vis-a-vis the dollar. A lot of news flow, of course. The RBI policy was there as well, but all of this notwithstanding, the rupee was lower in trade. That's the key thing. I think a lot of people are penciling in what will come out from the BJP manifesto, and if indeed it is more populist in nature than what the earlier indications were, and it could well be because of the Nyaya scheme. Then I spoke to a few currency traders yesterday on the global front, sitting in the Middle East, and they said that they would be short the currency if that were to happen. So maybe all of that is playing on the minds of the rupee traders. We do not know that, but yesterday was certainly a very sharp decline for the INR vis-a-vis the dollar. We'll get to know about all of that over the course of the next 2 days. For now, let's take a look at the stocks that could react in the session today. The macro is one picture. What happens to the micro? Titan Big news, and we'll talk about that. The sales, according to company update, have risen about 21%, and they are targeting 20% growth in FY20. Why and all, Agam will join in to speak about that, but this is that one important piece of news from a large nifty company, so do watch out for that one. It was not good news from the company that came out with results, not an update but results. GM Breweries, operationally a very weak quarter, EBITDA fell 16%, margins came off to 23.8% from 29.6%. Now, typically GM Breweries numbers tie in with what some of the other smaller companies would do, brewery and distillery companies. So we'll watch out for the impact that this news has on GM Breweries, yes, and some of the other smaller companies, not necessarily what happens to United Spirits and United Breweries. So those two are separate kettles of fishes, but GM Breweries certainly weak. By the way, USL yesterday on the social media groups, the commentary that came in apparently from the company wasn't the strongest. I don't have verification of that, but do watch out for the alcohol stocks in the session today. Rallis has gotten the clearance from the Pollution Control Board. They've revoked the closure of the Gujarat unit, so one more company that gets benefited out of that. And VST Tillers, the March numbers that they have posted, well, the power tiller sales fell 32%, excuse me. Tractor sales fell about 45%. So not the best of months for VST tillers and tractors. It's not a very liquid stock, so keep that at the back of your mind. But the numbers very, very weak. Let's wait and watch if that reacts in the session today. Well, so those are the stocks that to my mind could react. There will be a few more, of course, and we'll talk about all of them during the course of the show. But let's tell you what's landed up on First Word today, our collection of the top editorial stories that we believe we should bring to you. Air ticket prices may cost more this summer schedule, and Jet Airways has a big role to play here. Sumit Sarkar Johnson to tell us why. Organized diagnostic players have developed some ailments. Darshan tells us more about that. Agam takes us through Titan's claims of maintaining its sheen in the quarter gone by and this financial year, and maybe updates for the next one as well. And then Yash sums up how companies that listed in the last financial year are faring currently. Start off with the aviation news. Jet Airways is being cautious with the summer schedule. The country's oldest private airline has given up nearly 70% of its routes for the next 7 months. And that's also a tentative plan subject to change. Sumit Sarkar is here to tell us more about that and the implications of this. Sumit, this is not a very encouraging sign.
Yes, actually the signs are not at all encouraging, and that is because of the issues that we have been seeing with Jet Airways. Now, if you see, usually the summer schedule begins on March 31st and ends on October 26th for all airlines. But this time, due to the issues that we have seen related to Jet Airways, the DTCA has approved the summer schedule for Jet Airways only till April 25th. Now, as it is approved till only April 25th, this can be revised at a later stage, but we'll have to wait for that data to come in. Now, based on the data that has come in, it looks like Jet Airways has pulled out capacity on 174 routes out of the 252 routes that the company operated in the winter schedule. So that's a cut of nearly 70% that we have been seeing, and that is because of the grounding of the aircraft of Jet Airways that we have recently seen. Now, however, this data is till April 25th, and there could be a reversion in this. Now, this cut in capacity by Jet Airways is expected to benefit the Tata Group owned Vistara and Air Asia the most, because they have deployed more than 40% of their capacity on those 174 routes. As you can see here, 42% of the capacity of Vistara has been deployed on that 174 routes where Jet Airways has pulled out its capacity, while Air Asia has deployed 41. Air India, Go Air, Indigo and SpiceJet have deployed anything between 24 to 35%. These two players are the major beneficiaries of that. Now, as Jet Airways is struggling to bring back its grounded fleet, the domestic aviation market is also expected to see a moderation in the capacity growth. Now, if you see, for the total aviation sector, the capacity growth is expected to be only 3% to around 3,077 daily departures, which is the lowest in at least the last 3 to 4 years. We do not have the exact data, but analysts are saying that this is the lowest at least in the last 3 to 4 years. Now, if you see company-wise, Indigo's capacity is expected to grow only 20%, 21% in the summer schedule. This is against the backdrop of the growth that we have been seeing for Indigo in the last few months, that was close to 30%. And this slowdown in the growth for the domestic is because the company is shifting its focus more on the international routes, and that's the reason we are seeing only a 21% growth for Indigo. Now, for SpiceJet, they are expecting to grow at around 30%, and this is despite the MAX 737 grounding that we have seen, and despite the supply side issues that have been there for SpiceJet, they're expecting us a good growth rate of 30%. Now, as you can see here, Jet Airways growth rate has come down by nearly 76%, and that's the reason why the industry growth rate is only 3%. Now, for other players like Vistara, Go Air and Air Asia, the growth it is expected to be around 15 to 27%, while for Air India it is expected to be 36%, and for others it is close to be around 23%. Now, because of this groundings of this of the Jet Airways, we have been seeing on the slot side also, if you see from key airports, there are a lot of unused slots that will go in because of the groundings that we have seen for Jet Airways. Nearly 65 to 70 slots in Mumbai and Delhi airports are expected to be unutilized in the summer schedule because of Jet Airways grounding, and the major beneficiaries of now for this is. Now, if you see here, Indigo's slot capacity has increased by 98 to 99, while that of Jet Airways has come down from 91 to 24. Jetlight, the subsidiary of Jet Airways, has come down to around 11, and the total capacity has come down to 264 from 329, and that is mainly because of Jet Airways. Now, ICICI Securities believes that there would be a reallocation of this slot if the debt resolution of Jet Airways has been takes a longer time. Then they will have to reschedule. That will again pose a big problem for Jet Airways, because you see, this premium slots is the major asset for Jet Airways, and if that goes away from them, then the debt resolution or finding a new investor would be an issue for Jet Airways. Now, overall, if you see, this reallocation would happen for if the resolution takes time. Now, this is for the other key airport that we have been seeing, that is the Delhi airport, where the capacity has come down from 516 to 439, and mainly because of Jet Airways, because their capacity has come down from 100 to 23. And if you see for Bangalore airport, the capacity there has come down by only 8 slots, and that is because Indigo has acquired more slots in that airport, while Jet Airways slots have come down from 51 to 4. So this is something that we'll have to see how it pans out over the next few months, because after April 25th, the revised schedule for Jet Airways will come in. So far, this cut in capacity is expected to increase the ticket prices, which will benefit the entire industry, because in 2018 we saw the fall in ticket prices, which impacted their financials. So that is one thing that the industry will benefit. Now, Yatra's COO, that is Sharat Dhal, is expecting that for leisure travels, or the ones who are booking that ticket at an earlier stage, for them a 10% hike in ticket prices is expected. But for the business travelers who book at a later stage, for them the ticket price hike will be much more compared to the leisure travel. So that is something that will be benefiting the industry. That is a ticket price hike because of this cut in capacity.
Interesting. Samit, thanks so much for putting that into perspective. Just one small follow-up. I don't know what aside of Yatra, if any dealers or any reports have mentioned this, because from personal experience, I can tell you that if you're still booking tickets about 15 days in advance, the rates are comparable to what was the case before Jet kind of grounded some of the planes. But if you're booking extreme near-term tickets, then the rates are maybe 3x or 4x.
Yes, exactly. That's what he told me, that if you book 3 days of 7 days earlier, the ticket prices are very high, and that is because of the limited capacity that is there in the industry. That's the reason it is happening. But for leisure travels, the ticket rate is only high by around 10% so far. That's what he's telling us.
Yeah, much as we would like to believe that that is not the case, that is indeed the case. You book 2 weeks or 3 weeks in advance. I don't think the ticket rates have really gone up substantially higher than what was the case earlier. Samit, but thanks so much for putting that into perspective. Usually don't see analysis of this nature. Some of it, of course, gleaned from other research reports as well, but interesting perspective nevertheless. On to another space, and that's diagnostics. It's right in the thick of things right now, isn't it, with an IPO on. A growing population means more medical tests and health checkups. That's prompted diagnostic clinics to crop up across localities in the country. A recent note put out by a brokerage house, Haitong, suggests that it could in fact be one too many right now. Darshan Mehta is here to tell us about it. I'm surprised, Darshan. I would have thought with the population that we have, it is never too many.
No, it's not. The problem here is that, a couple of things why we did this is, first of all, with the Metropolis IPO, people thought that, there will be a re-rating for the sector. But in fact, it probably is working out for the negative, because more and more people are coming in, because diagnostic as a sector trades at a premium valuation to the other healthcare. You have 40-50 times. They are almost getting consumer valuations. So are these valuations here to stay? First of all, a few ground checks. Haitong did a market secured. They did a dealer survey pan-India. What they found out was that the pricing decline is clearly seen in the business to consumer sector. And business to consumer means that, you go and go to a diagnostic center and, collect your report and get your test done. There is actually more competition in the business to business segment. Here is where the hospitals or, other smaller labs are the customers of, a company like a Dr. Lal or a Thyrocare. So that's the difference. Overall, pan-India, what they saw was there is pricing pressure, competition is increasing. The other trends, when I got to speak about to a lot of analysts and some of the pathology experts and some of the diagnostic labs, what they're saying is the big problem is that the unorganized market is too huge. Almost 85 to 90% of the market is because of this unorganized sector. So the growth that people thought that the shift from an organized to unorganized will happen, that's clearly not happening here. Hospitals are in fact ramping up their own diagnostic businesses. You have SRL, which is part of Fortis, but the other hospitals also have started to provide a lot of in-house diagnostic treatments. Only the super specialized treatments probably go into these specialized diagnostic, but the basic ones are being done as also. So that's also a big impact for these listed players like a Dr. Lal or a Thyrocare or the to be listed Metropolis. So that's the trend that we're seeing in as of now. That's the problem, and unorganized is something that is impacted. Now, if you see the revenue numbers that have come out of late of Dr. Lal as well as Thyrocare, all of them have seen a drop as far as margin is concerned, and their revenues have also slowed down significantly. So they were clocking margins much higher, or Thyrocare about 40%, now it's come down to 36%. Even for Dr. Lal, the third quarter saw the margins come down to 22%. Dr. Lal itself says that it's not because of we haven't been able to take price hike. So that's another problem. They have been just trying to optimize, but if they don't take price hike because of the extincting competition, that's a big problem for these players.
Yeah, that's interesting. Darshan, the other bit is, I remember when Thyrocare came out with this IPO, the conversation was that the pricing may stay steady, EBITDA margins may even come down because the pricing was too high, but the growth numbers will still stay at a CAGR of 25-30%. Has that commentary from all the players changed now for the next 3-4 years?
Yeah, so basically what has happened is we spoke to Thyrocare, we spoke to Metropolis, Dr. Lal, we reached out to them, they said that they are in the silent period, so we take a little bit of commentary what they said in the third quarter. Now individually I'll tell you what Thyrocare is saying, that the cost pressures are being a big challenge as far as the listed players or the organized players are concerned, because they have to pay more taxes because they comply with a lot of norms, the legal requirements, the pathology, the doctors, because now where I was reading that there is a big shortage of pathology doctors, so the costs have gone up significantly, and that is something that an unorganized or a smaller player won't need. So that is where they and they are not able to raise prices. So that is what this thing they are saying. There is immense competition in the B2B segment, and the game has to be a volumes game now. So that's what they want to target. They are saying that the B2C market is relatively stable, and that is what even Metropolis say. But the B2B is the big challenge, wherein competition is severe, so price hikes cannot be taken, and they have to play the volume game. And that is what Thyrocare is doing, and they are saying we will focus now on the B2B segment to grow. But remember, that's a lower margin business as compared to a B2C segment. Now, what did Dr. Lal say post the numbers? They are saying the pricing pressure will remain. That was something that they spoke about. They again said they will focus on the volumes, and they're saying they will now focus more, because they can't take price hike, on ways in which they can cost optimize. So that was Dr. Lal. What Metropolis is saying, that there is immense competition from the unorganized players. There is no price hike that they can take despite the production, despite competition, and they are also building in for volumes. And remember, when you go in for the volumes play in B2B, the competition comes in, the margin also comes down, and you've seen how Thyrocare has corrected, because everyone thought that he will be able to play the volumes game very strongly, but the revenue growth didn't come in because there is immense competition. Now the problem here is, look at the valuations. On an FY19 basis, Dr. Lal trades at almost 44 times. When it will be listed, Metropolis will be at 37 times. Thyrocare has already corrected, the valuations are 30 times. Now compare that to the average pharma. Both are different, but if you're playing the healthcare, you'll get a Sun Pharma at a 20-25 times. You'll get Aurobindo at 14-15 times.
So
but
so much.
Yeah, so Diagnostic, obviously Dr. Lal got the premium valuation, largest chain in the business country, but it was the only one. Now with Thyrocare have already come in, with Metropolis coming in, probably a few others will come in. Probably if SRL is demerged, this thing, will the premium valuation sustain in a state where there is immense competition and margins are slowing down?
Okay, let's wait and watch. Darshan, thanks so much for putting that into perspective. So pain for the diagnostic space. Now, lest you think we are talking only gloom and doom, there is good news as well for the listed space. Titan continues to shine with strong growth in the financial year gone by, and similar expectations from the current year. In its update for the fourth quarter for FY19, the watch to jewelry maker has put out some encouraging commentary. Agam Vakil is standing by with the key takeaways. Morning, Agam.
Good morning, Neeraj. Well, this certainly is not a surprise. We've been speaking to the management over the previous couple of quarters. They've constantly been, suggesting that there's 20% growth for jewelry segment. But more importantly, when it comes to FY19, the fact that they've seen overall sales at 21%, slightly higher than their expectations, will be taken as a positive. And moreover, perhaps more importantly, they are expecting to follow through on same growth rate when it comes to FY20 as well, targeting 20% growth on a consolidated basis across all segments. And speaking of segments, let's talk about the different ones. Let's talk about the largest one, that's the jewelry division, which contributes to 83% of the revenues. In fact, it's 83% for the first 9 months of FY19. Well, they say that the business has remained steady and growth is again on expected lines. It is essentially the last 2 quarters that the company has seen a significant pickup, and based on that, they are expecting about 22% growth in FY19 against a target of 20%, which again the management had suggested that they were planning to close somewhere around this number. They've seen continued traction in collections, and they've actually named a bunch of them which have actually aided them in this particular financial year, which will include Utsav as well as Gulnaz, among many others which have done very well. Now we have to remember that the company is focusing on high value studded jewelry, which is the key driver for not only growth but margins as well. And of course, let's not forget the wedding jewelry focus here, and we've seen that big boost coming in 2 of the 4 quarters as far as Titan is concerned. It's also added 40 stores in this particular financial year. Moving on to watches segment, again after a very volatile past couple of years, Titan is now starting to see the consistency with respect to growth, and of course a lot of the strategies are showing some amount of results. So the division, this particular division, is seeing 16% growth for FY19, largely on account of not only something like brands, of course the key brands like Titan, Fast Track and Sonata are aiding the growth, but they've brought in a lot of smart products which are playing in, and of course the e-commerce is the key growth driver as far as this particular segment is concerned. And accessories is particularly standing out because it's crossed the 100 crore revenue mark as well. So that's one other thing which is contributing to growth. Finally, a segment which has been relatively volatile. It is one of the smallest segments for Titan, that's eyewear. But again, positive cues coming here because the number of customers served stands at 35 lakhs for the year as against 25 lakhs, and they eventually target 1 crore customers annually by FY23. So they have their targets set for this as well in terms of projections. And while this may remain volatile as far as analysts are concerned in the near term, the fact that there is stability in jewelry and watches is the biggest takeaway and perhaps a positive one as far as investors go for Titan Company.
Agam, nice one for putting that into perspective. Yeah. Keep in mind, when the management spoke to us a few days back, they sounded very confident of them doing well irrespective of what happens to the economy. So this update merely reiterates that strong belief, and the stock has had a fabulous run in the last 12 months, more importantly in the last 6 months. Last piece on First Word today. Not many companies took to the financial markets in FY19. There were fewer public offerings than the past few years, but how well did the markets receive some of the new entrants? Considering the spate of IPOs that we have currently, it's important to look at the IPOs that have come out in 2019 or FY19 as well. Yash Upadhyay has the scorecard. Yash, good morning.
Morning, Neeraj. So FY19 was one of the most dullest years for the primary markets, as concerns with respect to liquidity feared by the series of defaults by IL&FS, trade war concerns, higher crude oil prices and rupee volatility kept most of these participants away from the primary market. As a result of this, we only had 13 companies going public last year, which is the lowest number since FY15, when only 8 companies had come out with an IPO. In terms of the number of companies that came out with a positive return, we have 8 companies of those 13 which have given positive returns. Topping the list is Fine Organics, which has gained 68% from its issue price, along with the likes of HDFC, AMC, Aavas Financiers, all of whom have gained more than 40% since the date of listing, as well as rights issue, which has come in about 38% higher. The other key names to watch out for include the likes of Credit Access Grameen, Chalet Hotels, TCNS, and Zelpmoc Design, all of whom have gained anywhere between 6 to 27%. So 7 of those 8 have in fact managed to give higher returns than the Nifty as well in FY19. But moving on, let's also take a look at what are the factors and which are the top 3 outperformers in that space. We'll start first with Fine Organics. It's the largest oleochemical based additive manufacturer in the country, and one of the very few globally as well, with high entry barriers being one of the key positives for the company. The new product launches for its Zealandia joint venture, which caters to the bakery segment, that is a key positive, along with the fact that their volumes are likely to see a big growth going into the second half of FY20, following the expansion and ramp up of its operations at its Ambernath facility, which would increase its total capacity by as much as 46%. This is according to a brokerage report from Citi. Moving on, when it comes to HDFC AMC, it's the largest asset management company by AUM, with equity assets of more than 1.4 lakh crores as of February 19. It is the best positioned in terms of capturing the growth potential in the underpenetrated mutual fund industry in the country. It has had a strong execution record with consistent ROEs of over 40% and a wide distribution network being some of the key positives that continue to make brokerages remain bullish on the counter. Moving forward, let's also take a look at which are the key positives when it comes to Aavas Financiers. It is focused on the affordable housing segment in the rural and semi-urban spaces. So that offers a long growth runway for the company, along with the fact that it has managed to have strong asset quality over the last several quarters, as well as presence in less competitive segments. 92% of its revenues, they come from 4 states, and the company at the time of its IPO had mentioned that it would use the IPO proceeds for the expansion into newer geographies, which would again help bring in growth going forward as well.
Okay, Yash, what about the listings that did not do well?
Right. So we only had 5 listings which didn't really do well, the most recent one being that of MSTC. But let's also take a look at which are the other names which didn't do very well. Well, we start first with Garden Reach, down about 13.5%, along with Ircon International, down 15%. And the 2 big names that have fallen the most are Endostar Capital as well as Varroc Engineering, down anywhere between 29 to 39% since the date of listing. Let's take a look at which are the factors which are not working well for these names. Varroc Engineering has been a casualty of the slowdown in auto sales, be it both globally as well as domestically. In terms of globally, its clients such as Ford and Jaguar have seen issues when it comes to UK as well as China sales. It has a very high concentration of revenues from some of its top clients. Bajaj Auto accounts for almost 18% of its overall revenues, and 60% of its revenues comes from the top 5 clients alone. As a result of which, Citi, in its recent brokerage report just about a month or so back, had cut estimates by as much as 11 to 14% over FY19 to FY21. Moving forward, let's also take a look at which other factors not working very well for Indostar. While the AUM growth has slowed down on across the 9-month FY19 period, it has been on account of the slowing corporate book. Asset quality remains stable, but the stress in the SME book is something that analysts are keeping an eye out, as well as the fact that the higher share of the real estate portfolio, almost 30% of its overall AUM, does mean that smaller players like Indostar tend to get into trouble if there is a huge crisis such as the one that we saw back in October with ILNFS. And lastly, when it comes to Ircon International, well, brokerages continue to remain bullish on the counter. Even till date, most of the brokerages, they have a buy rating as well as a higher target price. But the key reason for the IPO not doing very well is the fact that it managed to list at the time when the markets were at the peak, and we saw a big move from those levels on the lower side. And because of those weak market conditions, the IPO hasn't quite worked very well for the company.
Understandable. Yash, thanks so much for putting that into perspective. That's key synopsis of how the primary markets or primary market listed stocks did in the year gone by after listing. And remember, a lot of activity in the primary markets at the current point of time as well, with one IPO already open and one slated to open today. But that's all that we have on First Word. Quick programming note though, we will talk about markets and what some of the individual pockets look like with Nischal Maheshwari, CEO of Centrum Broking Johnson at 9 a.m. Oil marketeers' earnings may bounce back in Q4, but Moody's expects oil producers to be better positioned. We find out why with Vikas Halan of Moody's Investor Service. And Mold-Tek Packaging is ramping up manufacturing in India to meet rising demand. We speak to Chairman J. Lakshmana about the same. But after this break, a full tilt towards the day's trade.
And welcome back. You're watching Indian Open right here on BloombergQuint Live. Good morning, Raj.
Morning, Devina. Interesting day of trade. The world news hasn't quite cheered whatever is trading in Asia too much. Nikkei, the only one, up about 1/3%. But interesting pieces of news. And if indeed there's a trade deal that is reached sooner rather than later, should only augur well.
Yeah, for our markets, though, we've taken a step back over the last 2 days. After hitting those record highs, it seems to be a period where people want to take some money off the table right now. FI is also selling out. Last 2 days were a negative number, but a smaller number than the big money that has already been coming in so far. The currency weakened quite a bit in yesterday's session, went up to 69.16 from levels of 68.44 that we saw in early morning trade. And even the bond yields post the RBI announcement saw a big swing from 7.22 all the way up until 7.34. So it's crucial to watch out for how these two elements react in morning trade. But let's take a look at what happened in the futures and options space with Agam Vakil, who's joining in right now. Agam, good morning.
Oh, well, good morning, Devi. Now, we may have seen 2 straight days of losses for the Nifty, but I think the biggest takeaway in this case is the premium at which the Nifty futures are trading at. That's an 81-point premium. This is significantly high, especially given that April is a relatively smaller series, considering the expiry will happen on the 25th of April. So we're watching out for further up moves as far as the Nifty is concerned. Now, yesterday we did see unwinding coming through for the Nifty as well as the Nifty banking futures. But when it comes to the WIX, that has also come off to a certain extent. Still at heady levels of around 18.65, nowhere close to what traders may consider a relatively safe, 17. But well, we're still seeing it come off to a certain extent. Now, let's talk about your open interest change, and this is where you're seeing a little more writing around the 11,800 and 11,900 calls. Not unexpected, considering we saw the Nifty come off. But moving on to your Nifty put call ratio, okay, this is the open interest distribution. 12,000 mark continues to remain the one with the maximum open interest. But coming down to your Nifty put call ratio, that has come off to around 1.21 against 1.42. Moving on, this is the same stocks that are in the F&O band, no changes. Adani Power, IDBI Bank, Jet Airways, and Reliance Power. And well, none have moved out. But Repco Home Finance stands out, considering a lot of shorts building into the system. As was the case for Reliance Capital, which was also significantly weak, 13-14% increase in open interest. Strides, on the other hand, Advance looking at longs, and the other one, which was also looking at longs, with Interglobe Aviation. So we keep an eye on this one. Of course, we have news with respect to the bidding beginning tomorrow for Jet Airways. So we will keep an eye on the entire aviation pack as to how it moves in trade today.
Right, Agam, thanks very much for that. So Jet Airways actually had almost a 10% intraday swing where the stock moved from its lows towards the end of the trading session, where you actually managed to close about 3.5% high. I think the high of the day was somewhere closer to 264 from 240 that it made in intraday lows for that counter. Interglobe had a good day nonetheless. Siddhartha Khemka, Vice President and Head of Research at Motilal Oswal Securities, is joining us on the show this morning. Siddhartha, thanks very much for taking out the time. What's the word in the morning meets in terms of the overall sentiment and the market mood?
Yeah, good morning, Devina, and good morning to all viewers. So today morning we are looking at a positive opening, mainly on back of the positive global cues. Last 2 days we saw some profit booking in the market. Nifty just managed to touch a new high, and the RBI policy was more or less on the expected line, so that was much discounted already in the factoring in the prices. So that led to some profit booking, which may continue given that we have seen such sharp up move in the last 1.5 to 2 months on back of the strong liquidity flows. On the other hand, the fundamentals are yet to pick up. The earnings momentum is something that we are still expecting to come by in FY20. Q3 seen some improvement in the top line growth. However, the bottom line growth is still much below expectation. I think Q4 would be on similar lines. Hence, that doesn't provide much comfort, at least on the index level, on the index front at these levels. So, on the overall long-term basis, we still maintain our positive outlook. However, we believe that over the next 2-3 months, markets could remain volatile, given that earnings are yet to pick up. The elections are still there. Global factors like Brexit, the US-China trade talks and the settlement and all those things would continue to have the overhang on the market. So any correction or dip could give opportunities to add to the quality names. One change in our stance has been that we have now become very positive on the overall mid-cap space, where we were earlier had a cautious stance. Now we feel that the overall correction in the mid-caps have been overdone, and there are pocket of opportunities where you see fine quality, where you see growth, and where valuations are still comfortable. One can go ahead and add these names and may not wait for the elections to get over, because these stocks may move up by that time.
Housing finance companies, and particularly Indiabulls Housing, the stock has seen an uptick of about 20% in the last 7 days. They came out with their Q4 update. It was a positive one. And in light of that, the stock has done what it's done. It's about 900 now. Is there more headroom left, or it's pretty much baked in for the stock?
Yeah, so Indiabulls we had seen getting impacted because of the entire ILFS issue and the asset liability mismatch that occurred after that, and they got stuck in between that. Otherwise, the core business for them was growing at a pretty steady rate, and the recent up move is, I think, mostly on back of the news about, even today morning we read the news on the merger talks with Lakshmi Vilas Bank. So that will give them the access to the low-cost deposits. The asset liability mismatch issue could also be taken care of. So if you see on the valuation front, it's still comfortable. The company is doing well. You can still have further upside based on the news developments that come out. Currently, if you see for us, we have a buy rating on the stock with a target price of 900. So that gives a little more room for upside on the stock as well.
It's already at 900, 898 is where the stock's trading at.
It's been a crazy move for this one, right? 22% in the last 7 days alone. It's leading the pack. The quarterly update, not that bad a number either.
But you know, it's surprising because it's a split within the pack itself of housing finance companies. So in yesterday's session, you had an Indiabulls Housing Finance and a PNB Housing Finance doing well. HDFC. On the flip side, you had a Repco Home Finance, which was one of the worst performers within the broader market pack as well. So it seems to be a little bit. Probably Repco Home Finance didn't fall as much. So, but
no, I mean it's had a volatile time. I reckon the larger players are doing much better, and the ones which are able to put out growth despite, or at least the market perceiving that they'll put out growth despite the issues currently, are probably doing well. Which HDFC, I mean, the market cap at 3.5 lakh crores. That's quite something that's happening for some of these financial names. But good going for some of the larger NBFCs for sure. Okay, Siddhartha, stay on. So much more to talk about. Beyond the ones that we've spoken already, there are a bunch of stocks that could react. We've already spoken about Titan in first word. There are some other stocks in news, and there are some couple of brokerage notes that have come out, which are important as well. So Nikki as well as Somit join in to talk about all of those. Some which could have a reasonable reaction in morning trade as well. Good morning, both of you. Nikki, let's start off with the stocks in news first.
GM Breweries, that stock is expected to be in focus. It's a tough quarter coming in for the company. The margins have contracted year-on-year basis for the company. Revenue, there is an uptick, but then that's quite a flattish kind of 4% kind of growth that we're looking at. Net profitability of the company has actually declined by 1.5%, and the EBITDA performance on absolute basis, that number is also shrunk by as much as 16% on account of raw material, which a percent of your sales has actually gone up to 70% as compared to 60% earlier. Sequential basis, if you look at the margin performance, it is an improvement out there, but then year-on-year basis, that trend is narrowing down for the company. Cipla, which has received an EIR report from US FDA for its Goa plant. So that's one company, again, that stock that we like to keep an eye out. Rallis India, we're expecting a positive reaction coming in on that counter. Gujarat Pollution Control Board has revoked the earlier closure order for the company. Back on account of that, we might just see a positive up move coming in on this counter. And the going is tough for VST Tillers, where the company has yet again reported disappointing set of numbers for March. It's a washout year completely for the company, but for the month, if you look at the Power Tillers division in terms of sales, that on month-on-month, year-on-year basis for the month of March has reduced to 32%, and tractors too has reduced by as much as 45%. Mercator, where the CARE rating has actually gone down and revised lower the rating it has for long as well as short-term bank facilities. That's on account of the company's inability to service and also ongoing delays in servicing terms loan that have been rated by CARE. So we like to keep an eye out on this one. Apart from that, Fidelity Fund is has bought 1.8% stake in Hinduja Global Solution at a price of around 625 per share, which is relatively at a discount price that we saw in previous closing session. And three stocks which have seen a revision in their price band from 5 to 20%. These three are Z Media Corporation, Thirumalai Chemicals, and Reliance Home Finance.
Okay, watch out for some of these, including GM Breweries. Thanks for that, Nikki. Samit, what do brokerages have to say?
Well, a couple of them on the brokerage side. The first one is on Odisha Cement, where Morgan Stanley has initiated coverage with the equal weight rating and a target price of 1,176. Now, according to the brokerage, the corporate restructuring done by the company is a medium-term positive for the stock. It also says that the company is well positioned to deliver a strong volume growth compared to the industry growth. And now it is expecting a volume CAGR of around 9% over FY19 to FY21 from Odisha Cement. From the industry, it is expecting a growth rate of only 7%. On the balance sheet side, the brokerage says that the company's net debt is expected to remain stable despite the capital expenditure plans of the company, and that is because of the strong operating cash flow that it is expecting from Odisha Cement. Lastly, it has given an equal weight rating for the stock as it believes that the valuations are in line with its peers. The second we have is on Jyoti Labs, where Macquarie has initiated coverage with an overweight rating and a target price of 215. And the brokerage likes the diversified product portfolio of Jyoti Labs with a presence in the mainstay categories like the dishwashing and the fabric care. And it also says that the differentiated product positioning, new product launches and investments in key brand will help the company gain some market share going forward. Now for Jyoti Lab, it is expecting its net profit to grow at a CAGR of around 21% over the next 2 years, and it is also expecting its return on equity to expand by nearly 220 basis points on the back of improved margin trajectory and balance sheet deleveraging.
Interesting. We'll watch out for all of these. Thanks for that. 2 or 3 names that stand out in today's stocks and news, right? One of them is, of course, Titan. We spoke about that in first word. The other one is what's happening to the aviation pack with the lenders inviting bids from April 6th for Jet Airways. And then some of the liquor names. It's only a small company, GM Breweries, which has come out with numbers, but it keeps that space excited. Come to you on this one, Siddhartha, Khemka, the liquor space first, if I can start off with that. Not that GM Breweries would be a stock that you guys would be tracking, but if that is any indication, margins seem to be under pressure. Would it be only restricted to the smaller players, or do you reckon the quarter might be tough for the larger spirit and distillery companies as well?
Yeah, Neeraj, so you're right, we don't cover GM, but the numbers do indicate the trend for the overall industry. What happened last year was the sharp fall in the ethanol prices had led to the margins going up sharply for the entire space, and that might come down a bit as seen in GM numbers. but that is not the major concern as of now, because that is something that we are all expecting. The volume growth and the valuations are something that the market is looking for. And another factor that is a major supporter is the consumption trend on the ground. That is picking up from last 2-3 years, where we had seen a lot of the government regulations and state government actions, the Supreme Court ban on highways. Those issues are now things of the past. Now these companies are looking at a clean slate to grow. Another factor which adds to is that in an election year, generally we tend to see some quasi stimulus for these kind of sectors. So the numbers might be slightly under pressure on a Y-on-Y basis. Nonetheless, that's a sector which continues to remain under focus, will do well in our view. And in that space, we have a positive view on United Spirits, which we upgraded very recently based on the valuation comfort compared to the peer United Breweries, which had sharply outperformed United Spirits of the last 1.5 years, to which now we have downgraded United Breweries to a neutral, mainly on back of the valuations. Apart from that, the other factors for both the companies remain pretty strong. So that's the view on the beverages segment.
Okay. Stay on with us, Siddhartha. Lots more to talk about. Shubham Agarwal, CEO at Quantsap.com, is joining us on the show as well. Shubham, good morning to you. Let's talk about the Nifty now. We breached that 11,700 mark on the downside yesterday. In fact, even breached 600. What's the sense here in terms of whether or not you do see a pickup at these levels, some buying coming back in, or the trend could likely continue for a few days?
Hi, good morning. If you look at the broader index, generally whenever the market is doing very well and it is in a trend, the major recommendation generally remains that one should look to participate more on stock-specific ideas, because index at times might enter in a consolidation, and that is what the phase we are seeing in the Nifty right now. So Nifty re-attempted its previous all-time high in before a breakout. I think that the consolidation is due because we have seen a one-way rally. And if a breakout happens on a one-way rally, generally, that is not very, very sustainable. And a consolidation defines the entire move and makes it more and more healthy. So in a nutshell, I'm expecting a consolidation with a support at around 11,500. Now, any pullback on Nifty to the level of 11,600 and lower, I think should be used as a buying opportunity. And overall target for the Nifty, even in this consolidation, the upper end of the Nifty, I believe, should be 11,900. So I'm expecting a consolidation. Any lower downtick on Nifty should be used as a buying opportunity. A similar view on Bank Nifty as well, where the levels should be 29,850 and lower is the buying range, with a stop loss at 29,600. And on the upper side, the target will be 30,800.
Okay. That's on the Nifty as well as the Bank Nifty. Let's take a look at some other stock calls that Shubham has this morning. So we're looking at a Hero MotoCorp and UBL. So two stocks, both buys.
Yes. So if you look at the entire auto space, the auto space as a whole has witnessed a lot of long build-up on the derivative data. And after the performance that we have seen in Maruti and some of the other names, I think Hero MotoCorp has confirmed a breakout yesterday. So it's placed at the lower end of the range, and after the 3-day consolidation, we had a breakout with OI getting increased. So this is an indication that in a short term, we might see a decent up move from Hero MotoCorp. So Hero MotoCorp is a buy for a target of 2750 and a stop loss at 2600. And the second buy call is UBL. So again, if you see UBL, and comparatively within this space, UBL has been one of the outperformers. And again, if we look at the momentum there, after a consolidation, we have seen a breakout. There was a continuation pattern on the chart from where it broke out yesterday. So I feel that now it is ready to retest its previous all-time high. So even UBL is a buy for a target of 1480 and a stop loss of 1400.
Okay. Watch out for all of those ideas. Siddhartha, Titan came out with its Q4 update yesterday, and it's indicating a strong Q4 with regards to its overall sales numbers as well as how the jewelry business would do for itself. 22% growth in the division that has already been witnessed in FY19, and the momentum could continue. Is this a stock that one needs to have in the portfolio?
Yeah, so Titan is now becoming more of a steady 20% plus compounder. One may say it's another HDFC bank that we've got finally, which promises of that 20% plus growth quarter after quarter, year after year. So the management seems pretty confident. Even in the previous interaction, they have reiterated that that is something that they are looking forward and very pretty sure about achieving that 20% plus growth in the next 4-5 years, especially in the jewelry business. And that is what has come out again in the Q4 numbers. Last 2 quarters have been pretty strong, and on back of that, that's one consumer name that has consistently outperformed in terms of the growth numbers that has come out. So valuation is something that in the entire consumer name we will not be very comfortable. Especially for Titan, the valuations, the premium valuations are justified, and that's one stock that has been part of our core portfolio recommendation from last 1.5-2 years now, and that's done pretty well for us. So we continue to remain positive on Titan, recommended as part of the core portfolio for the next 4-5 years. The stock would continue to do well on back of the strong performance from the jewelry business. The underlying structural change in the market is also supporting them. The unorganized to organized, the clampdown on the black money, these are all helping the national jewelry retail outlets, especially with a brand like of Titan, with the parentage of Tata's. They have benefited the most out of the entire issues that has happened on ground. That is something that we continue to like and recommend. We have a buy rating with a target price of 1300 that still gives another 17% upside. We'll definitely review the stock once the results are out and maybe upgrade it further. But till that time, yes, part of the core portfolio definitely.
Interesting. Once the results are out, maybe upgrade Titan further. It's trading at premium valuations, but I think that's what happens to these companies, isn't it? They may trade at premium valuations, but they deliver growth, and therefore the future earnings take care of the current valuations as well. It's happened with HDFC Bank all through the years, happened with Bajaj Finance the last few years, and now happening with companies like Titan, Britannia, and a few others.
So they match up. So then, the excess that you pay for it gets covered up by the earnings that they make. Yeah, and I mean, the confidence of the Titan management when they spoke to us, that doesn't matter what happens to the economy. Yeah. It may be gloomy, it may not be gloomy, but we will grow at 20%. That's what they said at the interaction, without putting a specific number. Now in the quarter, they didn't talk about the margins though.
Yeah, the margins.
But I guess 15% is what the street is anyways expecting from them.
Yeah, but a 20% growth number at times when growth is in perception looking shaky from a consumption company, I think that just quite does it. I know we're talking fundamentals, but Shubham, you want to come in on a trade position on Titan as well? The markets are looking sketchy, but I heard you mention that at lower levels you would go out and buy the market at large. What about Titan?
If you look at Titan, I think very clearly the trend is on the upside, and every time we do see a pullback there, we see a follow-up buying again emerging and it makes a new high. So generally in a stock like this, where the cycle is long and winding, which means that we have not seen any short built up in this entire rally, that's considered as a very, very healthy rally. And whenever it comes to the highest put congestion is actually the point where one should look to enter and build some long ideas. So if you look at Titan, it retested the level of 1100 yesterday, and 1080 is the heaviest put congestion area, which is a very important support for the sale. So I think it's a good opportunity to use this pullback as a buying opportunity. The stop loss should be placed marginally lower than the put congestion, which could be around 1075. And on the upside, I expect a target of 1160 on Titan from a trading perspective. So I think this pullback should be used as a buying opportunity, and one should look to build on.
Okay. Siddhartha, 2 stocks on which there were exclusive pieces of news yesterday from Bloomberg. I want to talk about the first one, and that is Zee Entertainment. Now, Bloomberg News learns that both Mukesh Ambani and Sunil Bharti Mittal might be in the fray. Bharti Airtel, of course, denied it officially, but there is always a slip between the cup and the lip, and things could turn around as well. My question is, if this is heading into a bidding war kind of a scenario for Zee, as a minority shareholder, would you consider that as a positive? And if a deal is around the corner, is that anyways positive?
Yeah, so based on the news flows, what we read yesterday and what we're reading today, so the earlier deals that was in talk with Comcast and as well as Sony were around 420 and 430 levels. So if you see the current price, that is the current market price is above that, and now that we are getting news of Reliance, maybe Ambani's and the Bhartis, the Mittals now getting into fray. So if they are bidding out even at a premium to current price, that may lead to a minority shareholders gaining. But what seems like is that in the last 1.5–2 months, the stock is already factoring in a new buyer at a level which, so if you are taking a majority stake of a 20–30% kind of stake, you need to give something on the table to the other partner as well. Now that entirely depends on what kind of valuations the new player is comfortable at to bid at. If there is a bid war or a price war, definitely it will help minority shareholders. But at the current levels, the upside or maybe the risk reward for a minority shareholder doesn't look much. Given that the valuations are at the levels where we feel that they are almost full considering the underlying fundamentals, and that the stock price is already moved up over the past 1.5–2 months, factoring in a new strategic investor.
All right, that's Z for you. Yesterday's session, stock closed at about 417. The other one is Yes Bank. That too is a Bloomberg exclusive of them looking to raise about 500 million via share sale. News has not been confirmed yet, but getting your sense on Yes Bank, the overhang at the time was that, what's going to happen with regards to capital raising for Yes Bank. With Ravneet Gill at the helm now, and with this particular news that we've picked up, are things looking slightly more upbeat for Yes Bank?
Yeah, so Yes Bank, most of the overhangs have now been done away with. The stock price has positively reacted from a lows of about 170, 180. It has moved up to 270, closer to its fair valuation. And if the news flows are to go by, the management or the company is looking to raise money, which was the last overhang for the company because of the RBI issues and the management issues. The capital adequacy was something which was of a concern for the market. If they are able to raise money, that would be the last overhang from here, and that would be definitely very positive for the future growth of Yes Bank.
All right, the stock there, though, has done exceedingly well in the recent past, as we know the stock has come back from sub 200 levels to a level of about 270, where it's currently trading. These are nowhere close to the highs for the counter, but still not a bad comeback for a Yes Bank. Trading opportunity, Shubham, for Yes Bank and Z?
If you look at Yes Bank, I think the last 2 days movement is clearly indicating that there might be a temporary pullback there. So for now, I would recommend an avoid, but if at all it corrects to the level of 260, that should be used as a good buying opportunity. So 260 and lower is the buy zone. And whenever that happens, the stop loss can be placed at 255, and then we would expect again a reversal to the level of 285. So it should be bought only on pullback. Whereas Z, if we look at the movement of Z, I think the derivative data is not so positive placed. And sometime back, we have seen that heavy shorts were getting built, even though yesterday we have seen a reversal trade. But even then, I feel that the overall trend is not very healthy. So if anyone is holding, 440 is the level to book profits. So they can maintain a trailing stop loss at around 410 and 440. If at all that comes in 3–4 days, I think that should be used as an opportunity to exit.
Okay, we'll watch out for all of these names, and within this whole list, of course, the other set of stocks to be watch out today is the IT pack that had a reasonably deep gash in trade yesterday. TCS down 3%, the others followed suit. The index down about 1.37%. It'll be interesting to watch what the index does, if indeed, or what IT does, if indeed the other benchmark indices were to have a decent outing in the session today.
30 seconds left to go for market pre-open. We're marginally higher for the SGX, so no major cues coming in there. Even from the rest of Asia, it's a slightly more muted performance. I think we've got only in Japan that we're looking at, which is up 0.25% or so. SGX, as I said, 9 points higher. More interesting one will be to watch out is what happens to the currency and the bond yields in early morning trade. That's Nifty 50 for you, 11,577 in pre-open, very volatile, big gyrations. We'll wait it out for a few more minutes. Sensex at 39,000. Big moves in Z, the first sticks thereabout. So while yesterday the reaction to the news towards the end wasn't all that big, you may actually see, some bit of settling in and digestion of the news in today's session. GAIL is up 3.5%. Titan is up 2%, Power Grid is up 2.8%, L&T is up 1.5%, M&M is up 1.7%, Tech Mahindra, Cipla, TCS, so IT makes a comeback in pre-open. Most of them up anywhere between 1.25% to 1.5%. Reliance Industries at 1368, Hero MotoCorp, a good pullback last 4 to 5 trading sessions. Though the gains have not been all that big, but the mood has been sanguine on the stock. Then you've got SBI, Britannia, some gains coming in there. Amongst the losers, it's BPCL that's down the most, of 1.2%. HCL Tech, HDFC Bank, Tata Steel are some of the losers. So it's a handful of 6 stocks only that have opened in pre-open in the red. Currency, no major change there from yesterday's close at least. It's still around 69.11 for the bond yields, which closed somewhere around 7.34. It's just about there.
Just a couple of stocks, Jet Airways and Interglobe Aviation, big day in trade yesterday. Let's see what they're doing in the session today, about 1% higher. These rates may change, but let's wait and watch what happens there. The other one is, of course, Interglobe Aviation, marginally higher in trade. And then stocks that could react on news, quickly 2-3 names, GM Breweries, Rallis and VST Tillers. Just point them out and see what they are doing in the session today. GM Breweries, surprise, surprise. Let's wait and watch. Rallis, about 4.5%. The Pollution Control Board has revoked the closure of the Gujarat unit. We saw what happened to SRF yesterday, not saying the same could happen to Rallis, but looks like it'll start off well. And VST Tillers, the numbers have looked wobbly. Let's wait and watch if indeed those stock is reacting. Well, maybe not quite. When you mark the currency, I just want to mark the bond yields once and just see what's happening to those. 7.34 was where we shut shop yesterday for the bond yields. Should come up on your screen. About 7.3480. The currency is opening circa 69 odd levels. So a bit of strengthening from yesterday's lows. But lots of stocks in focus, and we discussed aviation marginally between us. It'd be good to get a trade perspective, and in a bit Shrikant, Chouhan of course will join in as well, so that's something that we'll talk about too. But just one quick thought on Interglobe Aviation and Jet Airways. Shubham Agarwal, if you were to trade, if you're looking at the charts for all the three, not just these two, what is the best aviation stock to trade after this marginal opening in the green that we've seen?
If we have to choose a stock from aviation, I think very clearly the price performance would indicate that the best performer has been Indigo. And I would want to go with the outperformer rather than staying with the laggards. So I think Indigo, if you look at the price movement also there, since March mid, it has been consolidating and a breakout is very much possible. And the next level for the stock could be around 1500, which is marginally higher than the previous all-time high. So I think this one is ready for a new all-time high. So I would go with Indigo as a buying opportunity. The stop loss can be placed at 1405, and on the upside 1500 will be the next target for Indigo.
Shrikant Chouhan with us as well, Senior Vice President for Technical Research at Kotak Securities. Shrikant, we'll get your index view in a bit, but since we are already talking about stocks, you want to come in on your ideas that you were recommending in the session today?
Good morning, everybody. Yesterday the market was like very clearly down, but it recovered a little bit. Today we are expecting activity in all mid-cap stocks because now the market is in between. And if there is any further more weakness, then we need to see that whether the market breaks 11,550 or not. So some sideways activity is not ruled out. And based on that, we have designed our trading strategy. We like a few metal companies there, like we can put some money and we can trade with a short-term and medium-term perspective. Steel Authority looks good, on which we discussed in the previous week that the stock has formed some classic inverted head and shoulder formation and the target is close to 70. Now the stock is around 58, 59, but now we like Hindustan Zinc, which is trading around 288, 288.50. There we are expecting 295, 297 to achieve. With a stop loss at 276, we should look for adding Hindustan Zinc to our trading portfolio. We also like a few pharma and IT companies because if you go through with the chart of Indian rupee, then yesterday Indian rupee has formed double top formation close to 68.35, 68.40 levels. So overall, the formation is suggesting us that currency is now going to depreciate further in the near term up to 70.30, 70.50. That's the view. And based on that, we should focus on pharma as well as IT companies. Tech Mahindra looks good, which is around 774, 775. Here we can keep stop loss around 755 and target close to 810.
Okay. Tata Motors at 208 now at pre-open. And what a stellar run this one has had. Obviously, I can't compare it to the kind of thrashing that the stock has taken nonetheless. The last 7 days, it's been up 22%. Shubham, Tata Motors at 208?
Tata Motors, the volume action has been quite encouraging, but we should also remember that a decent up move has already been in place. And at any time, we might also see a profit booking coming in. But so far, the data are still positive, and we are not seeing any kind of an activity which would suggest to go and exit the stock. So I would not recommend a fresh buy, but for people who are already holding the stock, my recommendation would be that you can adopt a trailing stop loss strategy where 198, which is now an important support, becomes a trailing stop loss. And if this move continues, then I think the next target for the stock could be as high as 218. So I would recommend staying with if any long trade is there, don't build any fresh longs, and 198 is the trailing stop loss with a target of 218.
Okay, so watch out for those stocks as well in trade. As we speak and as the pre-open rates are looking to settle down, we might actually have a good start for the index. So about 0.4%. It might change marginally in 1 minute left for the pre-open rates to settle, but it looks like we'll have a good start in the session today. And across the board, there could be some gains with Z topping the 420 mark as well. So do watch out for those. And IT might not have a bad day today. So that's the other one. After the big crack yesterday, maybe there's a semblance of sanity. However, while we talk about what's happening in the secondary markets, there is action in primary markets too today. Polycab India is launching its initial public offering that opens today. Samit Sarkar is standing by to tell you all that you need to know about the company and its IPO. Morning, Samit.
Good morning, Neeraj. So if you see that it's the largest cable and wire manufacturer that is coming out with its IPO. Now the company is looking to raise close to 1,345 crore rupees at a price band of 533, 538, and at the upper end of the price band, that is 530, the company will be valued at close to 8,000 crore rupees. Now the offer is a combination of an offer for sale and a fresh issue. Now in this offer for sale, the promoters and World Bank's lending arm, that is IFC, will be selling its stake at around 945 crore rupees, while the company is raising close to 400 crore rupees via fresh issue, which will be used for debt repayment, working capital requirement, and for general corporate purpose. Now if you see, the company is into manufacturing and selling wires, cables, and fast moving electrical goods, now which also include the likes of electric fans, LED lighting, switches, switch gears, and solar products. Now the company's mainstay business is the manufacturing and selling wires and cables. As you can see, it generates nearly 90% of its revenue from that business, that is cables and wires. Now this that fast moving electrical goods item, that business was started in 2014 and still it contributes less than 10% to the total revenue of the company. On the EBIT side, 98% comes from cables and wire, while only 1% comes from the fast moving electrical goods item. Now it has a market share of around 12%, and is the largest player when it comes to the cables and the wire segment. Now this segment, that is the cable and the wire, now it is expected to grow at a CAGR of around 14.4% over FY18 to 23. Now this is at a faster growth rate compared to the last 5 years, where it grew at a CAGR of around 11%. Now this is is on the back of the rising consumer spending and government initiatives on the power and infrastructure sector. Now it has around 24 manufacturing facilities, that is what Polycab has, and 4 of them are related to the fast moving electrical goods. Along with that, if you see, it is also setting up a copper wire rods unit with Trafigura. Now this unit is expected to boost the company's backward integration. Also, it has around 2,800 dealers across India which have a retail touch point of around 1 lakh, and it also has 30 warehouses across India, which also helps them for the pan-India distribution process.
How does it stack up against its peers?
Now, in peer side, we have compared Polycab with Finolex Cables, KI Industries and Havells India. Now, if you see over FY14 to FY18, Polycab's revenue growth rate was better than that of Finolex and Havells India. KI Industries grew at a higher revenue growth rate of 17% over that period. But on the EBIT side, that is the earnings before interest and tax, the growth rate of Polycab was much better than its peers. It was around 27.7% over FY14 to FY18. Now, for Havells India, we have only considered their cables and wires and the fast-moving electrical goods division and not the AC division that was recently added in FY19. So this is how the company stacks up when it comes to the financials. On the balance sheet side, if you see, the Polycab's debt as of FY18 was close to 728 crore rupees. However, on listing, this would come down to 540 crore rupees because the company will be using the issue proceeds to reduce their debt, and also the leverage ratio would come down to around 0.2 times. On the balance sheet side, the company has a good balance, good and healthy balance sheet. On the return ratios, if you see, the company's FY18 return ratios have improved compared to FY17, but when compared to its peers, it is not at par compared to most of its peers. Now, like for FY18, the company's return on equity was 17%, return on capital employed was 25.1%, and return on asset was 8.2%. But when compared to peers, the peers like KI Industries and Havells India had a better return ratio when compared to Polycab. Lastly, on the valuation side, if you see, the valuations are cheaper when compared to its peers. Polycab's price to earnings based on FY19 annualized basis was 16.7, market cap to sales was 1.1, and EV to EBITDA is close to 9.4, which is cheaper when compared to peers like Finolex Cables, KI Industries and Havells India. Also, brokerages have given a subscribe rating to this IPO on the back of its cheaper valuations and a strong financials.
Samit, thanks very much for that. That's Polycab. The IPO opens today. Siddhartha, before we let you go, your quick take on whether this is a subscribe or no?
Yeah, Devina, so we have also come out with a note on Polycab with a subscribe rating, mainly on back of the company being a market leader in a niche segment, which is in a high growing segment, which is cables and wires, very strong brand name, wide distribution network, and the new plant which will add up to the backward integration and add up to the margins. Valuations are very comfortable at 16.7 times FY19 annualized, which is below or at par with the industries, especially the wires and cables companies of the likes of KEI and Finolex. While if you compare with the larger peers, the Havells, which are into the electrical goods, they are trading at much higher valuation, but they have much better financials as well. So given the financials which are marginally or in line with the wires and cable segment, the valuations appears comfortable. Given it's a market leader, healthy financials, we feel that this issue is definitely a subscribe for retail investors.
We'll leave it at that, Siddhartha. Thanks much for taking the time out and joining us today. Appreciate your time.
Thank you. My pleasure.
Minutes away from market open. Nischal Maheshwari is with us, but first let's tell our viewers all that they need to know to stay ahead in trade today. First up, Titan has guided for a strong growth in the fourth quarter. It sees 21% growth for sales in FY19. Also targets 20% revenue growth in FY20.
Civil Aviation Secretary has told Bloomberg that Jet Airways has 26 planes flying now. Lenders to the airline have invited bidders to bid for their 51% stake in the company. Bidding will open tomorrow and close on 9th April.
It was a disappointing quarter for GM Breweries, with revenue declining 4.5% and margins contracting to 23.8% from 29.6%.
Rallis India says that the Pollution Control Board has revoked its closure order of the company's Gujarat unit. The company had received the closure order on March 19th.
A slowdown in VST Tillers tractor sales continue. It has seen a sharp 32% drop in March sales volumes. Tractor sales fell 45% at 989 units for the month.
And India's largest manufacturer of electric wires and cables, Polycab, looks to raise 1345 crore rupees through its IPO, which opens for subscription today.
Okay, let's get a quick opening thought from Nischal Maheshwari. Nischal, good morning. Thanks so much for taking the time out. We'll get a detailed view in a bit, but Nischal, if you were to summarize the mood that exists in your house right now, is it investing at lower levels or is it being cautious because of the valuations? A quick summary first.
So I think we are being cautious at this moment. Basically, the market has run up quite a bit, and I'm very sure basically that the next 2 quarters are not going to be as strong as the market is expecting. Yes, there would be some hoopla around the elections, but I think beyond that, the numbers will come in and hit it hard, and I don't think we are seeing very strong offtake on the ground.
Okay, Nischal, 10 seconds left for the markets to kickstart. Request you to stay on. Our technical experts request you to stay on as well. We'll just take in opening thoughts from you post-market open. But here's how the markets are starting off this morning. Expect a start in the green. Question is, can they do more? About 1/3% for the Nifty and the Sensex. The Nifty banked to about 100 odd points. So about 1/3% here too. Not a bad start, I would say. Considering the close that we had yesterday, this is decent. Let's see if it holds. The mid caps and the small caps, which maybe performed a bit better than the large caps yesterday, starting off in the green again today. So the start is good. The market breadth is positive. Let's see if it holds. Bring up the heat map and show you what's moving within the large cap universe first. A lot of green, very little red. Maybe an HCL Tech in the red, but otherwise IT2 is not in the red. But the news is here. The top gainers, Titan firstly, reacting to a very strong guidance for FY20. What it's done in Q4 is passé. What is guided for FY20 is the key thing, and on that news, Titan is up about a couple of percentage points. And there is strength in private banking. Yes Bank, IndusInd Bank are amongst the names which are in the green, so that's good news. Cipla, newsmaker, about 1% higher. IndusInd Bank higher. Tata Motors marginally higher in trade, and I'm watching out for Z if I can see it. Yeah, about 0.5%. So not a big reaction today, but I think topping the 420 mark currently. Let's wait and watch if it does more. But all in all, fair degree of green, very little red, not too many losers really worth talking about. The top loser, as we see, is Adani Ports and less than 1% lower. So it's a start in the green. Just a couple of other trends that I want to highlight. Essentially stocks which have done well or not done well in trade yesterday and how well they're doing today. So yesterday's top losers included a Vodafone Idea, 3 days of losses, marginally in the green. NCC had a steep gash yesterday, marginally in the green. And Repco was the top loser on the Nifty 500 yesterday, marginally in the green as well. So the market uptick has led to these stocks doing well. And stocks which are in focus, like I said, Jet Airways, not quite having the kind of start that maybe few people would have anticipated. Lakshmi Vilas Bank, though, continues to do the unexpected, which is move up consistently. It's been, what, the 6th or 7th day of gain. Maybe they have an odd day in between where they haven't gained, but otherwise the stock has done exceptionally well. And SRF, after that big move yesterday, starts off cautiously, just about 0.15%. Actually very, very flat. Devina, what are you spotting?
You highlighted Lakshmi Vilas Bank. Last 7 days, the stock's propped up 47%. So, it makes you wonder what's getting the stock going right now. Volumes have been good, and the stock is really in a sweet spot. Aside from that, the other one that's looking promising is Godrej Properties, a new record high for the stock in today's session as well. So, the stock's up almost 5%, 44 points higher. The last high was 920. It took that down 3 days ago, went up to 928 odd, and today's session 963, which is a new life high for Godrej Properties. 1% beverages, 4% higher. You have SL Propack. Day before yesterday saw some selling pressure, but covered up in yesterday's session, and today's session the open has been more positive. From the housing finance companies, Divan Housing Finance, that's doing okay in today's session as well. Zensar Technologies moves up about 5% higher. You've got a DB Realty up about 3% I just want to take a look at Amar Raja Batteries for one. Day before and yesterday, the stock lost quite yesterday was down. Towards the end, picked up and shut short flat. The day before that was down closer to 8-9%. Today's session marginally higher in trade. Amongst the bigger losers, Reliance Communications continues to grind lower. Orient Cement, for one, the big mover of yesterday's session, is giving up in today's trade. It's down closer to 0.25%, though no big moves here. VIP Industries, City Union Bank are some of the other losers, but losses are very contained. 818 stocks advancing versus 308 stocks that have declined in trade this morning.
Shrikant, Chouhan, quick opening thoughts. We haven't taken your index call too. Are you buying the index at 11,633?
Neeraj, I think the way the formation is, one thing is very clear that we should look for taking some short bets at higher levels, and it's an opportunity that it open higher. So with a final stop loss at 11,670, which is very close by, because the market is forming consecutive lows. So with the same stop loss at 11,670, create short positions, and we can expect on the downside again 11,550, 570 on the downside.
Shubham, Godrej Properties, what's happening here? Is it running ahead of itself?
Yes, and if you look at this entire space, I think the entire space is also doing quite well. And then Godrej Properties, especially the last 2 days volume, and even if you see the movement today, is quite encouraging. And it's already hitting the new all-time highs, and I think it's entering into an uncharted kind of a territory. So I think it's a good opportunity to go and accumulate. May not be from a very short-term trading perspective, but I would recommend buying this as an investment in the portfolio. The stop loss will be a bit deeper because a medium-term position is what we are recommending here. So the 850 will be the level of stop loss, and 1050 to 1100 will be the next target for this one. So I think from a medium-term perspective, even after this decent up move, it's a good opportunity to go and accumulate for a target of 1050 to 1100.
All right, gentlemen, we'll leave it at that. Thank you so very much, Shubham and Shrikant, for joining us this morning. We're still in conversation with Nischal Maheshwari. Nischal, good morning to you. And since we were on the topic of real estate and the buzz that's been created in few of these names, is that a segment that you look at closely?
Pardon me, can you repeat the question, please?
I was asking about real estate and whether that's a segment that you look at closely, and is it an opportunity at this point?
It seems like basically, I think the sector is in deep correction. I think we are seeing some interest coming back. I think one of them was the successful closure of the REIT. I think that should revive the real estate sector, at least on the financial markets. The second thing what I see is a good interesting point is the interest rate cut. I think that should be, and it's an interest rate sensitive sector, so I think that should always be also be helping. So I think this is a good time to start accumulating some of the real estate shares.
Nischal, what's the broader sense though? Because I heard you mention in your opening remarks that you are cautious on the markets currently. What would the beaten down pockets, real estate for example, though I would argue that maybe it's not completely beaten down, it's made its way up a bit, but maybe real estate, maybe autos, maybe select NBFCs which aren't trading at fresh highs while the market is, would they be in a corrective mood too if the markets were to pull back as you believe they could because you are cautious?
So I think some amount of correction would be there. Obviously, I think these are all high beta stocks. But would they correct as much as they would have normally done basically if they were at par in the market? I don't think so. So given that high beta, yes, they will correct along with the market, but they would not do as much as they would have done normally. So I think these are safe spots to be in, especially auto I like a lot. I think this is a good time to start accumulating auto stocks. This is a cyclical industry, and I think you are buying most of the stocks basically at worst of the cycle. So I think there is good value out there. I think some of these stocks are now available at the valuation of a commodity, like the two-wheelers, especially Hero Honda and Bajaj Auto. I think they are available at around 6.5 times EV to EBITDA. So I think this is a very, very good, interesting spot to be looking at.
Okay, interesting. So we've spoken about two rate sensitives. Let's throw in the third one as well, Nischal. What are you doing with the financials? If you were to put in fresh money to work, would it be at the expensive large cap private sector names like Kotak and HDFC, or would you prefer the corporate facing banks? Again, they are not as cheap as they were 6 months ago, or are you looking at a completely different bucket?
So typically, if I would have got 100 rupees to invest at this moment, I would put around 40 to 50 rupees in the corporate banks, because I think for the next 6 to 9 months they will do very well. But I would put another 25 rupees basically into the NBFC space, because that's where value is emerged quite a bit. And I would want to take this thing basically, and the remaining I think 25 rupees should go into the large cap banks. So that's the way you should be playing this sector. Some amount of risk should be taken. Growth is another big part which you want to play, which is the corporate side, and some amount of hedging in the hedging with the large cap banks like HDFC and Kotak's. So this would be a typical way to play this BFSI space.
For the NBFCs, what kind of growth rates are you factoring in, Nischal? I mean, obviously not the heady 22%, but would you safely assume growth rates could hover around 15%?
For the banking sector, you're saying?
NBFCs.
So NBFCs, yeah, somewhere around 15 to 20% is what my estimates are. Basically, I think most of the people have been guiding there. Whether it was Edelweiss or most of them have been guiding between 15 to 20. I think the heady days of 30% plus have been gone, because I think the liability is still a challenge for them. So I think most of them are guiding 15, and we are also looking at around 15 to 20%, somewhere around those numbers only.
Is there a specific category of NBFCs that you particularly like right now, Nischal?
So I think asset financing is what we like at the moment. So whether it is mortgages, whether it is CVs, whether it is consumer goods, I think that is what we are liking at the moment, rather than actually the funding part. So asset financing is what we like, and I think that's better suited in the market currently.
Nischal, we were speaking to Amul yesterday, and they mentioned that they believe that in the food space at least, volume growth for FY20 could well be in the region of 14 to 15%. He mentioned that if he doesn't do it, somebody else will, but the industry-wide growth rate could be 14-15%. This coming from India's largest, arguably India's largest food company. Are the reservations around what the volume growth numbers would be, and therefore valuations that these food companies have, a bit unwarranted? Managements are sounding extremely confident.
I also agree with you, Neeraj. We have just put out a report on the FMCG sector, and we are very confident that the volumes would be much better than what the market is expecting. And our call remains to be that the growth is on the rural side, and rural is actually growing not almost 1.5 times the urban. That is the way basically rural has been doing, and given that the focus has been rural, it's an election season, a lot of money is being put into the rural pockets. So I continue to believe that the FMCG, food and all will continue to grow pretty well. We believe volume of our report says around 11% volume growth. I think I wouldn't be surprised that food grows better than that also.
And that's interesting that Nischal says that, because Amul said pretty much the same thing, rural, and he defined rural as not just villages but even low income groups in cities which might do well. The question is, Nischal, therefore, if indeed the growth comes in anywhere between 11 to 14%, whatever the numbers may be, are these companies giving you an opportunity to make fresh investments, or is it a case of staying invested if you already have been invested?
So I think a lot of the large caps are actually giving you an opportunity to stay invested only, like levers and ITC of this world. But I think smaller companies, we are positive on Britannia. We are positive on smaller companies like Bajaj, Bajaj Care, the oil company, the Almond Oil Company, Bajaj Consumer, I think that's the name exact. Then we are positive on Imami. So I think these smaller companies are giving you a better, because they have corrected a bit because of whatever reason. So I think this is a good time to accumulate them.
All right. Anything else, Nischal, that you know, from an earnings point of view, could turn the corner? I mean, obviously, you know, certain sectors that have been under pressure probably will continue to reel. One being telecom. but anything that you feel has turned the leaf and could actually see a momentum pick up?
Maybe metals will come back. I think metals had a poor quarter last quarter, so I think metals would be doing better. Again, the PSU banks pack, that will do better basically, because obviously the write-offs would be much lower in the current quarter. So I think these are the two sectors basically which can maybe give positive surprises.
Do you think the quashing of the Feb 12 circular is probably a step back for some of these banks?
The February 12th circular, which got annulled. Okay. So far, I think for PSU banks, I think in the short term, I don't see any reason, because they have anyway provided quite a bit. And if anything more, basically, this allows them not to provide further, given that they are not supposed to be taking, like it gives at the discretion of the banks whether to take it to the NCLT or not. So I think provisions may be delayed a bit, so it will be positive for the PSU banks on a short-term basis, but on a longer-term basis, I think the issues will still come back. So short-term, it would be really positive for the PSU banks.
Oil now hovering around $70 per barrel, Nischal. You know, weighing on the oil and gas space, and particularly big wigs like Reliance now, certain concerns around, and some downgrades also that have come about on the counter. With regards to the overall sum of parts business. What's your sense within the pack itself and for the oil marketing companies in particular?
So oil marketing companies, I would be cautious basically, because I think they have had a good run recently, and thereafter still if oil crosses 70, I'm not very sure actually they have the ability to pass it on. So that is one caution basically one should look at it. I think the oil marketing within the oil space, I think Reliance stands out, and Reliance has now become more of a technology company rather than actually an oil marketing E&P play or an oil and gas play. So I think Reliance is separate, and then we like the gas space totally. I think that seems to be doing pretty well. There is a good growth as far as gas is concerned, and the penetration is going up. Yeah, stocks are a bit costly, but I think that's a space basically which we like.
Nischal, one final question from my end. You may not look at that very closely right now, but in your previous assignment, I know you guys were amongst the first ones to come out with these long-term reports on specialty chemicals and chemical sector in India and how there could be a multi-year growth run ahead. A number of conferences I reckon you guys did as well. My question is, the story's played out well. Is the story good enough to play out for the next few years too? Is it possible to even predict that? And if so, do they provide investment cases? Because now a lot of them are larger mid caps. They are no longer the small caps that they were 5 years ago.
I still agree, Neeraj. I think that's still playing out on a much larger scale. And our thesis at that time still holds very true, basically, that China is still fighting pollution, and China is still closing down those plants. And the second thing remains to be that that they want to actually, sorry about that, they want to also diversify their source basis. So they want to go from one country only to to more than one country. So that's why you're finding more and more guys basically on the chemical front now coming into India, basically trying to do CRAMS, what we had earlier seen happening in pharma. So we continue to see that there is a good demand out there, and this thesis will continue to play out. And I don't see that, at least for the next 2 to 3 years, there is any slowdown on that front.
Okay, Nischal, thank you for taking the time out and being with us today. Appreciate your time and look forward to have you more often on the forum.
Thanks, Neeraj. Thanks a lot.
That's the view from Centrum Broking, Nischal Maheshwari. Bullish on autos and some of those beaten down rate sensitives, believes that even real estate could play a part. in this uptick at the mid-cap end of the market, but cautions on the markets at large right now because of the run-up that we've seen. Speaking of the markets, 0.5% higher now, so we only trended higher for the first 20 minutes. It's too short a time to call it a trending day, but for now, it certainly looks like the start has been decent. The question is, can it hold on? The mid-caps and the small-caps too are not doing all that badly, so the market by and large seems to be positive. On the other side of the break, a couple of conversations. Firstly, all marketeers, the earnings may bounce back in Q4, but Moody's expects all producers to be better positioned. We find out why. Vikas Halan of Moody's Investor Service Johnson, and then Mold-Tek Packaging, which is ramping up manufacturing in India to meet rising demand. We speak to the chairman, J. Lakshmana about the same.
Welcome back. You're still watching Indian Open. Straight-run PSUs are known to maintain a steady dividend record, especially so in the oil and gas space, be it ONGC or the fuel retailers like HPCL, BPCL and IOC. But Moody's Investor Service says that trend may well be detrimental to their credit ratings. More so for the oil marketeers who are otherwise expected to post healthy numbers in the fourth quarter. Joining us now from Singapore is Vikas Halan, Senior Vice President in the Corporate Finance Group at Moody's Investor Service, to explain why. Thanks very much for joining in, Vikas. Let's get in a sense from you as to what exactly are you witnessing as a bigger threat to the dividends that most of these oil marketing companies are paying out in terms of their overall Q4 numbers, and how that will be effective on that.
Yeah, thanks, Devina, for having me. The oil marketing companies have not been paying steady dividends. This is a very recent trend. ONGC Oil India, yes, there was a steady dividend, but ever since the DPAM guidelines came out, the dividends almost tripled by oil marketing companies. And this is something that has been putting pressure on these oil marketing companies. Let's not forget they've also spent money on acquisitions, which has resulted in increase in borrowings. Now, on the Q4, which is January to March quarter, what we have seen is the refining margin in the region have basically dropped to one of the lowest that I have seen. So the average for January to March, the refining margin, at least in the region, was $3 or so, and that was saved by a recovery in March. So we don't expect the numbers to be great in January to March, especially if you exclude inventory gains. Yes, there would be inventory gains which could help them, because in October to December quarter, there was a huge inventory loss. So there would be some bit of recovery because of that. But underlying refining margins were really bad in January to March quarter. And therefore, what we expect is if the refiners continue to pay dividends, and more importantly, because they have done share buyback, particularly Indian Oil Corporation, the big share buyback they did in January, is putting some pressure on their credit metrics. And although the upstream companies were able to afford it because oil prices were going up, the downstream companies, the refining margins went down, and therefore we think it's going to put pressure on their credit metrics. And that is where we come with a divergence in the view that it is affordable for the upstream companies because of high oil prices, and let's not forget no subsidy burden or no additional tax. And it is not as well positioned for the downstream companies because of lower margins and also lower petrochemical spreads.
But compared to the previous quarter, when crude oil was at heady levels of about 86, we're still not at those levels. We're still close to about 70. So how does that weigh in terms of the difference between the two quarters, Q3 and Q4?
So if you look at the average oil prices, even for the last quarter, it wasn't that high. The average for this quarter is also not significantly different. But what is different is the quarter end prices. So between the beginning of the quarter, in the last quarter, October to December, as you rightly pointed out, the crude was closer to 80, but by the end of the quarter, it was more closer to 50. So there was a huge inventory loss that they had to book. But in this quarter, when we started off with closer to 50, we are ending closer to 70. So you are going to recover in terms of the inventory losses as such, because they take into account at the quarter end prices. Whereas for the upstream companies, the average prices matter more, and therefore we think that earnings improvement that we saw for the upstream companies will continue to be sustained. The earnings will be sustained, but the growth may not be there.
You also talk about constraints to credit profiles because aggregate borrowings might go up for most of these oil marketing companies, and even the likes of an ONGC, if they have to maintain that steady dividend payout that they look at.
Not so much for the upstream companies, but more so for the downstream companies. And there are a couple of reasons that differentiates the upstream versus the downstream here. Now, the downstream companies, even though the subsidies have been taken out, there's still DBTL, which actually has to go from the oil marketing companies first, and then they ask for reimbursement from the government. So this reimbursement has been getting delayed and delayed. So previously it used to get reimbursed within a month or so. Now I think it's taking closer to 6 months. And that is why the working capital increases for the downstream companies. So in addition to payment of dividend and share buyback, you are now doing a delay in subsidy reimbursement because the government has its own fiscal maths to think about. So there is a increase in borrowing structurally because of that. This is almost going back to the pre-2014 days, not to that extent because the subsidy amount was huge. Here the subsidy amount is lower, but it all adds up because the dividend has gone up, share buyback is being done, you're spending in capacity expansions, and then you also have to bear the subsidy working capital increase. So all of this adds up to the increase in borrowings. Things are not looking as bad yet, but if margins go down further from where we are, and so that results in earnings decline, cash flow decline, and they continue to maintain this high level of dividend, then we have an issue. But at the moment, things are still just about fine and within the rating tolerance level. What we are saying is, if this continues, then we may have an issue with the credit quality of these companies.
And you say that IOC is better positioned than BPCL within the credit matrices.
That is correct. Even though IOC has done share buyback, even though IOC has increased or paid interim dividend, and BPCL has reduced its interim dividend, IOCL started off with a lower leverage than BPCL. BPCL was already closer to debt to EBITDA of 3 times, whereas IOCL was around 2 times. So even though IOCL's leverage will increase, it will still be below 3 times, and BPCL's leverage will increase above 3 times, which is where we draw the line in terms of our tolerance. So that is where we think if they continue on the path that they are, there is a risk of them breaching the downgrade trigger. BPCL would be the first if they continue with their dividend policy. And then if IOCL continues also, they will go down that route.
Let's talk about, pricing of fuel pre-elections and what happens if at all. There is a case where most of these oil marketing companies are probably told not to take price revisions ahead of elections, and how that works out.
Yeah, it's interesting. So, the election period is about 40 days. And, let's say you start price freeze 10 days before that. So you're talking close to about 50 days. And within that 50 days, the total consumption of petrol and diesel, the prices of which may be frozen, is close to 130 million barrels or so in India equivalent. Now, if you take $1 price absorption during that period, $1 per barrel, you're talking about a total of $130 million of distributed between the 3 companies. So I don't think it's going to have such a big impact if there is not a price increase or decrease in the market, or the price increase decrease in the market during these 50 days is close to a dollar per barrel. But it is seldom $1 per barrel. When you look at the volatility, it could be $10 per barrel. If that were to happen, yes, there could be an issue. But to expect a sustained increase in price of $10 over 50 days, that's not something that we are expecting at the moment. I mean, let's not forget the gasoline spreads are close to an all-time low because of high inventories. Yes, there has been a recent improvement in the gasoline. The rupee has appreciated significantly, which also plays into the math of the pricing at the retail stations. And you've got crude oil, which is already at close to 70. So is there a further significant uptick from here in the prices? Unlikely. But if that were to happen to the extent of $5 to $6, you're looking at overall 500 to 750 million if the worst case scenario really happens. But the other side of the equation is that if actually prices fall, would you be recovering those losses? And what we have seen in the past is, yes, if the prices actually fall, they recover the losses. So over a 50-day period, it could go one way and then come back the other. And overall, you may not end up losing anything. And even if you lose something, the continuity of a government coming back to the power, that could allow you to recover those losses post-election. So if you look at it over a longer period, then it is unlikely that this particular thing will have an impact, unless the price volatility are very, very significant. So yes, there is a risk, but I think the impact might not be very significant.
Got that. Vikas, it was great chatting with you and getting your insights. Thank you so very much for joining us on BloombergQuint this morning.
Thank you. Thanks for having me.
Right, that's a quick word on the oil marketing companies and obviously the earnings impact going forward with regards to even the kind of dividend payouts they have and the elections that are upcoming.
Well, interesting thoughts there. Moving on to the next conversation, Mold-Tek Packaging yesterday said that it will shift some of its equipment from the UAE unit into India to meet the growing domestic demand. The move comes even as it continues to expand its local units, which are expected to accrue revenue starting this quarter itself. The ramp up seems to be in time in preparations to meet the expected 20-25% volume growth in FY20. But is this expansion driven by broad-based pickup in orders from consumer companies? Let's put all of these questions to the chairman, J. Lakshmana Rao. He joins us right now on the show. Mr. Rao, good having you. Thanks much for joining in. You certainly expect buoyancy in FY20.
Yes, with the new addition of the equipment and the orders that are coming in edible oil, and mainly the two plants of Vizag and Mysore getting into production, the volumes and growth rate should pick up in the coming quarters.
Okay. There is a note that I have, Mr. Rao, which speaks about how you have set the ground to deliver exponential growth because the volume growth driven by commercialization of the Mysore and the Vizag plants will be very, very robust. Can you give us some color of what's the volume growth that you anticipate, and for how long do you anticipate, looking at the current economic conditions, this volume growth to last? Would it be a year's phenomenon? Could it be a 2-3 year phenomenon? Could it be more?
Yeah, it's going to be at least for 3 to 4 years because the ramp up of these units is already indicated by Asian Paints. From 3,000 tons per annum capacity, these are supposed to be ramped up to 7,000 tons in the next 3 to 4 years' time. And already the call-ups have started for Mysore. Commercial supplies started in March in a small way. But the numbers for April are very encouraging. And going forward, out of the 6,000 tons of capacity, that's almost equal to 20% of our capacity. Probably at least 15 to 17% of the capacity, that means overall capacity, might be added. So apart from other growth factors of edible oil and thin wall containers in IML sector, this paint sector alone can contribute somewhere around 15% to the growth in the year 1920.
So if this will contribute to about 15% growth and then the other businesses will also add more, are we to assume that, and I presume you're talking about volume growth right now, we've not even touched pricing, but are we to assume that your volume growth could be 15 to 20% as well in FY20?
Yes, that's what I'm talking about. The volume growth from paint industry, that is Asian Paints plants from Mysore and Vizag alone, could be in the region of close to 15%. Let's say 12 to 15% to be conservative. And the rest of the products which we are introducing in the thin wall food sector, that's ice creams, edible oil, key packs, which are already catching up now, can contribute at least another 8 to 10%. So we are confident of crossing 20% volume growth in the year 1920. And this trend can continue if the Asian Paints catch up with what they promise or what they anticipate from the market. That's going from 3,000 tons to 7,000 tons each at both these two plants at Mysore and Vizag.
So conservatively 20%, if I add up the numbers that you mentioned, it could go to as high as 25% in FY20 as well. If indeed Asian Paints were to continue a gradual ramp up of the units that you're saying, would you believe that a northwards of 15% or a 20% growth over FY20 can be seen in FY21 as well, Mr. Rao? Or is it too soon to predict?
Yes. We are confident we will be able to continue the trend of at least 15 plus growth, volume growth in the coming couple of more years.
Okay.
Soon our plans to open another plant in the north. We are in talks with the two major paint companies. And once we conclude, probably by end of this year, we'll have a smaller plant starting up by end of this year, which could be ramped up in the coming couple of years. So this will be another small addition, like maybe 4 to 5% per annum. That would be further adding to our volume growth. So the next 2-3 years, at least 3 years, look at 15% plus growth is possible.
Interesting. How is pricing shaping up, Mr. Rao?
Pricing is positive thanks to more and more volume of food and FMCG goods we are selling. And EBITDA margins, which we have gone up from 17 rupees to 33 rupees per kg in the last 5 years, can be retained or at least might maintain at the same level.
Okay. So are we to assume that margins will pick up as well? I mean, higher volumes would anyways, I presume, lead to better EBITDA margins. What is it that you would estimated, what is the estimated EBITDA margin in FY19 and what's the pickup that you envisage in FY20 and FY21?
It has reached 33.5 levels in the year 18-19, and going forward I'll be very happy if it stays around 34-35 range because of the variety of products that are coming in, and paint industry also is growing, which doesn't have that kind of luxurious EBITDA margins, but has a decent margins. So with the addition of the food and FMCG adding to the numbers, the overall combined average could be somewhere around 34-35 is what we are targeting.
Interesting. And the food and FMCG business, while you're talking at length about the contracts that you have with Asian Paints and maybe in conversation with 2 other large paint companies, the food and FMCG business seems to be the one that could be the game changer for you on the margin front, or am I wrong?
Yes, on the margins front, we have much better margins, more than double our average in the food and FMCG. Thanks to the small size of the containers and the complexity of the IML technology and what we deliver, the value add to the clients, they are ready to pay for it. So we typically get a much higher EBITDA margins. Now we are entered with Hindustan Levers for their ice cream range. They call it flavored yogurt. And going forward, we are looking at a lot of opportunities from both Levers, Procter & Gamble, and mainly Mandalese. We are talking with them. But these all projects take time to really implement and get them on board. Meanwhile, our regular growth in the paint industry continues to add to our growth.
We'll of course talk to you post your quarterly numbers, Mr. Rao, but one final question. If indeed revenues and margins are all slated to rise, would it mean that all of this would happen with higher return ratios and better cash flows? And therefore, part 2 of my question, for any of the expansions that you're talking about, would you need to raise any kind of equity capital, or would internal cash accruals do the trick?
See, the last year was a huge capital investment of more than 55-60 crores, which is far ahead of above our cash accruals. So we had to dig into the loans, but that is being a very low debt equity ratio company, we could easily get that arranged from the banks. So going forward also will be depending more on term loans if it's needed. But the year 1920 might be a little, more of utilizing the created capacities. So additional capital investment could be in the region of 20 to 30 crores, which is well within our cash inflows. Unless we set up an arc plant in a bigger way than what we anticipate now, there won't be any need for even term loans in this current next financial year.
Okay. We wish you all the best for all of that and more. Thanks so much, Mr. Rao, for joining in today and giving us that perspective.
Thank you very much. Have a good day.
Thank you. You too. Well, certainly good times. The management is very confident of the numbers ahead.
Markets for themselves also looking pretty confident right now, about 50 points higher, so holding on to those early morning gains. 11,645 for the Nifty, the banks about 30,000, 143 points nudged up. Broader market space also looks pretty encouraging. With that, it's a wrap on this edition of Indian Open. From Neeraj, myself and the entire team that's put this show together, thanks a lot for watching. Lots more action on the FNO show.